Amidst skyrocketing inflation levels, there is much speculation among investors as they wonder what the best possible investment is to protect their wealth. CEO of Berkshire Hathaway Warren Buffett previously touched on the best investments during times of high inflation. We have talked about protecting one's wealth amidst this time in many previous videos, and today, we will dive more into Warren Buffett's view. We will also hear an analysis by Monish Pabrai on his investment strategy during this time. Stick around until the end to know the best investments to protect your wealth. Before we begin with the video, we'd like to express our sincere appreciation for all the support that you have been giving our channel, and we'll be sure to pay you back with more informative finance content. Investors are anxious and unsure of where to place their wealth because of the nation's record high inflation rate.
We're seeing very substantial inflation. It's very interesting. I mean, we're raising prices. People are raising prices to us. It's being accepted. Take home building. I mean, the cost of, we've got 9 home builders, and in addition to our manufactured housing thing, and then operation, which is the largest in the country. So we really do a lot of housing. The costs are just up. Steel costs just every day.
The most recent reports indicate that the annual inflation rate has now reached the level of 9.1% over the course of the previous year. It has been over a decade since the United States has experienced such high levels of inflation. The Federal Reserve is responsible for bringing inflation under control, and in these kinds of situations, they typically hike interest rates. Since the start of 2022, the Federal Reserve has been attempting to strike a delicate balance between reducing inflation and avoiding a recession. As a result, they have raised the interest rate on multiple occasions, but the most recent hike of 0.75 percentage points is a hint that the Fed is working more actively to combat inflation. Since 1994, this marks the first time that the Federal Reserve has increased the rate by such a significant amount. As a result, the price of $500,000 mortgage went up by $4,000. This reduced consumer purchasing power. When couples have limited purchasing power, they tend to focus more of their attention on paying off their mortgage and credit cards. This has the effect of slowing down the economy as a whole since people spend less money, which, in turn, leads to a decline in stock values. On the other hand, businesses with large debts have risen in price as well. Therefore, it is essential for investors to gain an understanding of how they might shield themselves from the effects of inflation at this point in time. Because of growing costs, their purchasing power will be diminished if they keep their cash on hand. On the other side, the equity market is fraught with significant unpredictability, and there is a chance that falling prices will lead to a drop in wealth. Now, let's find out what Warren Buffett believes to be the safest place for your money to be invested in light of the current economic climate. Buffett believes that when it comes to investing in today's market, 2 things are especially important to keep in mind. Therefore, let's listen, and then we'll dissect each argument in detail.
They're the ones that require little capital investment to facilitate inflationary growth, and that have strong positions that allow them to increase prices with inflation. And we have a candy business, for example, and the value of the dollar since we bought that candy business has probably fallen at least 85%, I would say, 80 to 85%. And that candy business sells 75% more pounds of candy than it did when we bought it, but it has 10 times the revenues, and it doesn't take a lot more capital. So that kind of a business, any business that has enough freedom to price to offset inflation and doesn't require commensurate investment or a huge investment to support it, will do well.
For Buffett, the 2 things to counteract inflationary pressures are pricing power and a business that is resistant to inflation. To begin with, let's talk about pricing power. It is a shorthand way of saying that the corporation is in a position to raise prices in order to reduce the effects of inflationary pressure without experiencing any adverse effect on the amount of demand for the product. This is due to the fact that the company possesses a competitive advantage over its rivals. There are several examples of this, including the Apple ecosystem, Facebook, and Costco's low costs. In 1982, when the United States was experiencing a devastating inflation rise, Buffett emphasized to Berkshire Hathaway stockholders that they must seek out companies with a high price hiking capacity. Even when there is no change in the demand for the product and the capacity is not being utilized to its fullest, there is no need to be concerned about a major drop in unit volume or market share.
Usually what happens when you have inflation is usually wages don't keep up. So if inflation is running 10%, maybe wages might be going up 5% or 7%. Usually there's a lag. And so purchasing power is declining. And in economies like India, where food and energy can be a huge part of the pie for most lower middle class and poor people, then I think even strong brands will be challenged to raise prices. On the other hand, if you're Louis Vuitton, you're at the top end, you have very strong ability to raise prices regardless of inflation, because the rich are getting richer and they've got limited places where they can spend their money, etc. So I think that inflation hits these different companies and products in very different ways. And it can be a very strong headwind for some businesses, and it can be a much lighter headwind.
Therefore, the key to understanding this viewpoint is to realize that businesses that enjoy a significant advantage in the market have wide moats. However, not all businesses that possess a competitive advantage are able to endure periods of inflation. In order to do so, they must possess a competitive edge that provides the company with pricing power. Else, they will continue to have difficulty. To put it another way, pricing power is the most important factor. If you are the most famous beauty brand in a developing nation, your sales may still suffer during the inflationary time. This is likely due to the fact that your products are unaffordable. As an illustration, Netflix is an example of a premium good that the masses have purchased and for which they pay a monthly subscription price. Netflix is renowned for transforming the movie renting market, and they enjoy a competitive edge due to their lack of main competitors. On the other hand, if a customer's financial situation is precarious, they may cancel their subscription altogether in an effort to preserve their funds. Conversely, names such as Louis Vuitton or Ferrari are unlikely to have the same impact. The explanation for this is that Louis Vuitton and Ferrari consumers are extremely wealthy individuals. And even during times of rising inflation, they are able to keep virtually the same amount of purchasing power. Beyond the fact that they have a large moat, you should also ask who is purchasing these items, which is a very interesting point made by Monish. This is a very crucial question to ask when trying to identify companies that are not likely to be negatively affected by inflation. Now that we have covered the first aspect, let's move on to the second one, which is identifying companies that are resistant to inflation. By this, we mean selecting enterprises that do not require significant financial investments in order to continue operating normally during times of high inflation. In this particular setting, Buffett has said that businesses should be able to handle significant increases in both the volume and value of their transactions. This is frequently caused by more inflation than by genuine growth, with just a marginal increase in the investment of capital.
If you have a business where most of the capex has already happened in the past, they would be deriving the benefits of that capex in the future. Let's say, for example, I own a hotel and I've already built the hotel and it's up and running and I don't plan to build another hotel, etc. If we had strong inflation, assuming there weren't, changes in many more hotels being built around me, the odds are high that if it's in a good area, that the nightly rates might go up in lockstep with inflation. That's possible. Because you did the capex in yesterday's dollars, inflation actually is not going to hurt you. If you have to use those dollars to build another hotel, it's going to cost you a lot more to build the next hotel. And so in that case, it becomes difficult. But if you are milking the cow, so to speak, on old capex that you've done in old rupees or dollars, then it's an advantage. we are best off in a world where there's no inflation because that makes the analysis easier. But when we have an inflationary environment, it is important to try to understand which businesses will do well in that environment and which businesses will struggle in that environment. And I think it relates a lot to the capital expense that a business has to do.
Therefore, the second point stresses finding businesses with well-protected capital investment. Businesses like these aren't affected by inflation because they've already completed their first capital expenditures. Consider Coca-Cola, a firm that has been since 1982 and presently sells over 1.9 billion bottles each day throughout the world. As a result of the high demand, the company has already made significant investments in expanding its production capacity. Since the company has already invested in today's dollar, they don't need to spend any more money setting up new manufacturing facilities. This gives the corporation the competitive edge of an inflation-resistant business strategy. It means that when inflation is high, they may easily raise the price without causing any major problems. In essence, it increases their profitability. Inflation actually gives them a competitive advantage over brands that, in order to increase their market share, must increase their capital expenditures by installing new manufacturing facilities and increasing their marketing and sales expenditures during inflationary periods. Therefore, it is prudent to seek out organizations that have already completed their capital investment. Firms whose market share and competitiveness depend on higher investments will be hit most.
Utilities, which get, in effect, a bond-like return, but require, if you're going to build a generating plant and it costs twice as much per kilowatt hour of capacity, and all you're going to get is a fixed return, and yields on bonds go up, perhaps dramatically if you get high inflation, is not going to do that well in an inflationary period, just because it has certain aspects of a bond-like investment, and bonds generally are not going to do well in inflation.
According to Monish, the businesses that are milking the cow are the ones that don't need to make significant new investments in their capital on a regular basis in order to keep up with their competitors and remain in the same competitive position. As a result, while making an investment during an inflationary time, two crucial factors must be taken into account. Nevertheless, we are enthusiastic about introducing one more essential component, which is that there is no silver bullet in inflationary periods. This idea comes from Warren Buffett, and it is something that we take to heart. This indicates that there is no way to totally sidestep the inflationary problem. It is a difficult time for investors, and you should be aware that the following years will be even more challenging.
Bonds can swindle the equity investor too. Everything, inflation, I should say, swindles the bond investor too, and it swindles the person who keeps their cash under their mattress. It swindles almost everybody. If you really could have a totally stable unit of monetary use for the next 100 years, it would be better for business and investors in general.
Therefore, we will conclude by stating that the investment climate is not great. Due to an increase in interest rates, businesses are projected to stall. Investing requires forethought and a reserve of finances in case of unforeseen circumstances. We will strongly recommend that you do not invest the money that you will need to meet your financial obligations over the next few years. You should not engage in speculation over the amount of returns you have earned over the course of the previous year or perhaps even the previous decade. You need to maintain your rationality and look for businesses that have cheap capital requirements and evident pricing power before investing in them. You need to think long-term. Don't be alarmed if your investments suffer short-term losses or drops in value. What did you guys think of Warren Buffett's analysis on what to invest in? What are your planned investments during this period of high inflation? Give us your thoughts in the comments section down below. If you enjoyed this video, kindly like and subscribe, and we'll catch you on the next one.